Good evening, ladies and gentlemen. On behalf of CFS Society Sri Lanka and EY Sri Lanka, I would like to welcome you all for today's webinar on the impact of the Internal Revenue Amendment Bill 2022 on the financial services industry. The main objective of today's session would be to discuss the salient features of the Internal Revenue Amendment Bill issued on the 11th October 2022 and how that will impact the financial services industry. We are very pleased and thankful to EY Sri Lanka for collaborating with CFS Society Sri Lanka in bringing this session to you. Also, I would like to thank our eminent panel from the financial services industry who have kindly accepted our invitation to be part of the today's session, despite of their busy schedules. Before I hand over our session to our moderator today, let me also take this opportunity to thank our sponsors, our platinum partner, Colombo Stock Exchange, silver partners, equity partners, Capital Alliance Group, First Capital, NDB Capital Holdings, Senfing, USA-based Sri Lanka. Also our knowledge partner, Equity Knowledge Partners, print media partner, Daily FD, text messaging partner, TextFair. Also, I'd like to thank our supporting partners, ACCA, SEMA, and National Chamber of Commerce. So with that note, ladies and gentlemen, let me hand over the session proceeding to Mr. Aruna Pereira, the Vice President of CFS Society Sri Lanka, and also he also the Group Financial Officer of Analytical Instruments Private Limited. Aruna, over to you.
Thank you very much, Aruna. Good afternoon again. I think today we are going to discuss about the impact of the Internal Revenue Act, or rather than the Act, the Amendment Bill, and the impact of that to the from the perspective of the financial services industry. We also have three eminent panelists who will discuss about the new bill, the proposed bill from different perspectives. We have Dilshan Veerasekara. Dilshan is the chairman of the chairman of the Colombo Stock Exchange, director and the chief financial officer of First Capital Holdings PLC. We also have Ravi Abesurya, director as well as the past president of CFS Sri Lanka. He currently serves as the advocacy chair as well. He's also the CEO and the director of Senfin Securities. We also have Mr. Nandika Buddhipala, chief financial officer of Commercial Bank of Ceylon. He's the chairman of the National Chamber of Commerce as well as the president of the CISI National Advisory Council of Sri Lanka. Thank you very much for agreeing to take part in today's session. And over to you, Suleiman, to start the presentation on the impact of the Inland Revenue Bill.
Thank you, Aruna. Right, good afternoon, everyone, and welcome to this session on the new Inland Revenue Bill, which has been much talked about with significant changes that have come about, and its impact to the financial services industry very broadly. I would like to first thank CFS Society for inviting me to do this presentation and to be part of the panel. I will try to take you through this for probably the first half an hour to 40 minutes, and then we'll progress towards the question and answer as well as the moderation. So on the bill itself, it has several effective dates, right? Unlike a normal amendment which comes in with effect from a certain date, this has been made a bit more complex than that, where there are several effective dates for different amendments. So if we just go through these dates of significance that we need to probably look out for, The first is October 1st, 2022, which is already passed, right? And this cutoff date is for the commencement of the new rates generally, right? So wherever a concessionary rate moves to a higher rate, they have made it effective from October 1st. And so there will be 6 months of the old law during this year, that is the year of assessment 22-23, the running year. So first 6 months they have put a cutoff under the old rates, and the second 6 months will be the new rate. So if the law does get passed as it is, then this provision technically will have a retrospective effect, right? Because you'll be paying a higher rate of tax from a prior date, if at all. Then the second timeline is the commencement of the Amendment Act. That is when it really gets passed. So some provisions, for example, the PAYE provision, where they deduct taxes on your salaries, the withholding tax provisions, where they deduct tax on your interest payments, and dividend payments, for example. So wherever there is a withholding, which is generally upon a payment, those have been made effective only from the day the law gets passed, right? So that is when it's passed in Parliament and certified by the Speaker. Then there are some provisions that are coming into effect from April 1st, 2023. So that's a clean year. They're taking certain provisions, certain exemptions, for example, are going on for the whole year till March 31st, 2023. And from April 1st, 2023, those exemptions are ceased. So where there are exemptions being taken out, they are generally from April 1st of next year. And there are some provisions that are going all the way back to April 1st, 2018. There are some on 2021, and then some in April 1st, 2022. So those have significant retrospective effect. So to give you a background of where this stands, as you know, this was gazetted as a bill. And the next process is that there is a time period given to challenge it for constitutionality in the Supreme Court. Now, as you must have heard, there have been about 8 to 9 petitions that have gone to Supreme Court challenging this bill on various areas from its constitutionality. So we are waiting for the Supreme Court to rule on it. And if there are any provisions that are not in line with the Constitution, the Supreme Court will give their ruling on that to the Speaker. And they will say which provisions these are. And if it's not constitutional, then such provisions would require a 2/3 majority in Parliament or referendum or both, right? So where there are provisions that do not require such a passing with a referendum or a 2/3 majority, then the bill can go ahead to Parliament and can be passed with a simple majority. So we are waiting for that at the moment, and that's where it stands. So it's not law at the moment, and that's something we all need to appreciate and take in mind before we make any decisions. Right. So the structure of today's presentation is basically I'll quickly run through the impacts on corporate tax on the basis of a sector analysis and a quick update on withholding tax. Then we'll apply it to the financial services industry. And lastly, let's take up the impact on personal tax, which affects each of us. So on the industries, one of the biggest industries that contribute to both employment and foreign currency earnings is exporters and indirect exporters, who have for the longest time been enjoying a reduced rate of income tax, right? It has been 14% all this time. And now from October 1st, there's a very significant increase, more than double of the rate to 30%. And again, from October 1st is what we understand as per the bill, if the bill is passed as it is, right? Of course, most of these BOI companies do have, export companies do have BOI agreements, and most of those agreements would likely carry a reduced rate, which needs to be looked at to see if the reduced rate can be taken as per the provisions of the BOI agreement. So there may be some concession there, but by and large, all exporters will, if they don't have it, will have to go up to 30%, and that will have to be the industry impact of that will probably reflect in the capital markets and which should be taken into account. The next is supply of goods to exporters. That also was at a 14% and now going to go up to 30 from October 1st. Here again, many of them are likely to have BOI agreements, but it's something that needs to be analyzed on its applicability. Provision of services to exporters, also there is a reduced rate where those services are directly connected to the export of the goods. That too will be moving up to 30%. The whole value chain on the export line will now be at 30% on the profits. So these exporters, those suppliers to exporters of goods and services are affected by this mandatory conversion rule, because to get that reduced rate, they had to get foreign currency from the exporter, which he couldn't do because of the mandatory conversion. But this law, what it has done is, it is sort of giving a concession where the exporter can't pay in US dollars. They are allowing for the exporter to give a confirmation of his foreign currency receipts to that supplier, to the exporter, who can then use that to take the reduced rates. But that will be only relevant for the first 6 months, because from the second 6 months onwards, all of them will be liable at 30%, even if it's paid in foreign currency or not. So this concession of giving a statement will be required for the first 6 months to prove the foreign currency receipt. The next significant sector is the manufacturing sector for local sales. They also had a significant concession from 2019 at 18%. That is also to move up to 30%. Agriculture is one of the few areas that have been spared. They had agro farming, that is the primary growing of agricultural produce, whether it be coconut or tea or rubber. The primary grower was given an exemption, a 5-year exemption from 2019, which is to end in 23-24, and that has not been affected by this amendment, so that exemption still stands. And there is also an exemption on someone who's doing agro-processing, right, where he uses his own farm, where he farms his own agro-produce and does the processing. Since processing liable at 14%, there's a deemed exemption on the transfer of the agro-farming products to his processing facility. That's on a market value basis. You take the profit, and that part is also exempt. That also is to continue till 23-24. So the agro-farming sector has been spared by these concessions. The agro-processing sector, however, are not that lucky. They were at 14%. They are also going to go up to 30% with effect from October 1st, 2022. There is an additional concession given for anyone doing agro-farming, agro-processing. That is where you do the primary processing of the agri-product, and manufacturing. That means further processing, right? If you are using your own agricultural produce, where you grow your own produce for manufacture, or you grow your own produce for agro-processing, there is an additional reduction of 25% of the tax payable, right? You get a sort of a concession there. That was available for 5 years. That is now brought down to 2 years and will end next year. So that is running year, 2022-23 will be the last year to avail this 25% reduction in taxable income for such manufacturers and processes. Gem and jewelry industry, another significantly industry that was given concessions, and they are one of the few that had an exemption on exports, right? The exports are exempt, no income tax did they pay. So that exemption is going to come out, we removed from April 1st, 2023. So that's running all the way to next year, right? So that's not changing from October 1st. They'll have the balance of the whole year as an exemption, and from April 1st, 2023, their profits too for export and re-export of gems will also be 30%, just like all other exporters. IT and BPO industry and services for foreign currency also were exempt all this time, and they are to be made liable again from April 1st, not October 1st, April 1st, the exemption will move to a liability of 30%, right? So they'll also be liable to 30%. Both the IT sector as well as primarily the IT sector from April 1st, they'll be liable. Yeah, so as you know, the withholding tax regime is coming back again, not from October 1st, but from the passing of the law. So when the law gets passed, these sections will get triggered, and when you make a payment, you'll be liable. So one of the payments is payments for services to any professional, which will be a professional individual, right, not a company. Will there be a 5% withholding if the amount is more than 100,000 per month? Shipping, logistics, and warehousing, things like entrepot trade, front-end services, offshore business, headquarter operations, transshipment, and freight forwarding, all at 14%. All are going to get increased to 30% from October 1st. There was a final withholding of 2% for non-resident transportation on land and sea that will continue. And the dividend exemption for hub services under the Finance Act, having a BOI agreement, will continue to be exempt. So few of these exemptions are remaining. Warehousing, on the other side, exemptions for letting bonded warehouses are to be discontinued. There was a concession rate also for bonded warehousing, also will be discontinued from October 1st. Tourism, again, another industry that we are looking towards recovery, at least in this December period and thereafter. But that too will now be liable at 30%. Hotels and outbound tour operators were at 14 all this time. So October 1st onwards, it will be 14. So it'll be interesting to see if the government looks at other ways, such as rebates or some non-fiscal incentives to this industry to make sure that we can capitalize on the lost ground the last 3 years, some way or the other, to increase dollar earnings. Education again was 14% in the last 2 years. They'll be moving to 30% again. However, government-assisted private schools will continue to have an exemption going. So similarly, payments made to lecturers and teachers who are individuals and not employed, but practicing as professionals will have the 5% withholding coming in. Healthcare also going from 14 to 30. And here again, the issue with paying doctors is always a problem with the withholding tax coming in. So that again is going to have an impact. Withholding tax on consultancy fees will apply from the time the law comes into effect. Another area that they have sort of brought in is the small and medium, that also has not been spared, I would think, unfortunately. So even if an SME makes ₹1 million profit or 10,000 rupees profit, they will have to pay 30% of that as tax. So it may not be prudent for SMEs or startups to start with companies, because these are the rates applicable to companies. They may have to start small as sole proprietorships and then get the tax-free allowance perhaps, and then move into a company once they establish themselves to sort of be able to manage the cash out on taxes. Right, so that is the corporate tax side. Moving on to withholding tax. Like I mentioned earlier, withholding tax is, the regime is to come back, similar to what was there 2 years ago to some extent. Interest and discount is to be 5%, but significant change is not a final tax, right? Earlier, it was a final tax, so there wasn't much more applied on it in the case of individuals. But now, for both individuals and companies, it's only an advance payment. You can take the certificate and claim it against your taxes, depending on where you stand in the slabs. And if it's a company, it will be taxed at 30%, and they will be able to deduct 5% that they get as a WHT certificate. Rent on amounts exceeding only 100,000 per month, earlier it was 50. but the rate is 10%, and again, not a final tax. Dividends was 14 earlier. Now it was exempt. That really there was no withholding. But before that it was 14%. Now they're bringing in 15%. But some relief is that it is a final tax, right? So to an extent, from an individual's perspective, it is more favorable because earlier, if you're the highest bracket, you would have paid 18%, but now it's 15% final. But for a company, it was 14. Now it's going up to 15. And the tax exemption on dividends paid to non-residents. So any non-resident who earned dividend income out of a resident company was exempt. That exemption also is to be removed. Right, and the other key change is what we mentioned earlier on the withholding tax on service fees paid to independent service providers. Right, so not companies, but independent service providers in their individual capacity. If they provide a service to you, then there is a requirement to withhold 5% on all these categories of people like doctors, engineers, accountants, lawyers, software developers, and so forth, if the amount exceeds 100,000 per month, which is again not a final tax, but you need to give them a certificate which they can claim against their taxes. So impact to the financial industry, and the significant one, I think there'll be a lot of talk around this, is the listed entities, right? Who listed between 1st January of last year, 2021, to December 1st, 2021. They were given a concession, a 4-year concession. The first year, they were given a 50% reduction in the tax payable. That there has been no change in the law. So that will continue, or it will be available. But the second concession is for 3 years of assessment commencing from 2022-23, right? At a reduced rate. This has been removed, unfortunately, from October 1st, 2021. So if we just look at this table, the impact is that, so each of the years of assessment are top yellow, and then the current 50% reduction, the current is on the first line. So a 50% reduction in the year 2021-22. Then for the next 3 years, you were given a 14%. However, the proposed is that 50% reduction in the first year will be there, but then subsequently 14 is going to go to 30%. So the impact of that, we have just done a quick calculation to assess it. So if you take, if you had a taxable income of 100, which is there in the second column, 100 for 2021, you would have 100 into 24%, and you would have a 50% discount on that. You would pay only 12. Proposed is also 12, so no change. Right? For the 3 years, if you had 100, you paid 14% of 100 into 3 years was 42 is the tax you would have paid. But what is proposed is the 14 goes up to 30, and you will now pay 90. Right? So there's a 114% increase when you look at the tax payable as a quantum over the 3-year period. Right? Overall, if you take the 4 years together, it's a 89% increase. So rather significant increase in terms of those entries. But in recent discussions we had with the ministry officials, they were also sort of open to relooking at this, and I think submissions are going through for those who did list, because there was significant costs involved, and they were open to discussion on this. So potentially, if that they are convinced, they will probably allow this in the committee stage amendments. So the next is investment in shares. The investment in shares on the capital gains on investment in shares, the exemption continues. Right, the gain of listed shares, the exemption continues. Also, the realization or the sale of shares of a non-resident company by any person where they have substantial participation, right, where they hold more than 10%. If they sell a foreign company, that exemption still continues, and the sale of listed shares also still continues. Right. However, the gains from the realization of an investment asset, meaning shares that are held for investment that are not quoted, will now, if it's owned by a company, increase from 10% to 30%. Right. and anything owned by an individual, there is no change. That will continue to be at 10%. However, the cost that you will deduct, right? So if it qualifies to be an investment asset in capital gains, whilst you will pay the 30%, there is still the cost. How you determine the cost is the market value of 30th September. That has not been changed, right? So there is some concession there not to tax the growth in value prior to coming into effect of the new law, which was in 2017. So they're looking at the appreciation of an investment asset, and I reiterate, investment asset from 2017 onwards only. However, that concession is not there for a business asset, which doesn't fall within the definition of investment asset. So that categorization should be looked at carefully. Then on dividends, received from a resident company, there was no withholding earlier, but now there is a final withholding of 15%, which will be a final tax. So what is important in terms of a difference here is that when the withholding tax was not there, whilst companies did pay 14% tax on the dividends they received, they were allowed to deduct expenses, right? So things like interest, brought forward losses were deductible. So a company may not have had a liability because the deductions were allowed. However, now the rate also has gone up by 1%, but being a final withholding, you can't deduct any expenses, right? So to that extent, dividends will be taxed gross on the amount received. So that's something that needs to be evaluated. Then dividends distributed out of dividends received, right? Dividends distributed, dividends received. There is an exemption for that. However, provided only if the 15% withholding tax has taken place. Okay, so this 15% withholding tax is only coming into effect from the passing of this law. So any dividends that you receive prior to this date, right, up to let's say 2019, there was no withholding. So all those dividends that you have received, you have now already paid the 14% tax on. Now, when you redistribute that, there is no clear exemption that covers it as it stands, right? So do you have to then withhold another 15%, right? So this, because this exemption on redistribution of dividends received is limited to only if you have deducted this 15% under this new amendment, which you wouldn't have done for dividends received up to date, right? Because the law was not in place. So there is a lacuna there, which we have brought to the attention of the authority. And they also, their principle, or at least the policy, is that you should have at least paid tax once, right? So I think there is a suitable amendment that is likely to come in the committee stage to adjust that so that there is no double hit on the dividend received. Again, dividend received to non-residents is not tax exempt anymore. That exemption has been removed. So exemption continues for dividends received from non-resident companies derived by a person who has substantial participation. So if you own more than 10% and the dividend comes to Sri Lanka, then the exemption that was there, that will continue. And dividend paid by a resident company which is engaged in hub services, there are a few conditions to meet. Those dividends also will continue to be exempt. Treasury bills and treasury bonds and other government securities. So here again, there are quite a significant amount of exemptions. But so there is this Samudri community-based bank who receive treasury bills and treasury bonds, that continues to be exempt. Withholding tax, although it has been imposed on interest from banks, has been specifically excluded. At least the exclusion that was there before is still applicable. That has not been amended on treasury bills and treasury bonds. Okay, whether it be interest or discount, right? So there will be no withholding tax as the law is on treasury bills and treasury bonds, but the recipient of that interest will have to pay his own taxes on a self-assessment basis. So no change to earlier, but a company will now be taxed at 30%, and an individual will be taxed at progressive rates, going all the way up to 36%, which is quite significant. Other government securities, there's several exemptions, like I told you, on sovereign bonds, interest and discount sovereign bonds denominated in both Sri Lankan currency and foreign currency is exempt. SLDBs, again, any person on foreign currency, sovereign bonds, and SLDBs also, the exemption continues. And the gain from the realization of ISPs to any licensed commercial bank where the investment after April 1st, 2021 exceeds 100 billion will also be exempt on the gain. Right. Interest income exemptions continue on FCBU accounts or special deposit accounts. The interest income is exempt. Interest income to a non-resident on loan granted to a person in Sri Lanka or the government is still exempt. So that's interesting because they are made dividend liable, right? But they have continued with the interest exemption. So there may be, when you're structuring investments, that may be a useful method to look at to encourage foreign capital flowing in, because the loan, and I think loan, how you structure it and the type of instrument it is to make sure it falls within this exemption is something that needs to be looked at. Then the interest on an MNC from foreign currency account maintained to cover import expenditure is also exempt. So where there is no exemption, the 5% on interest will apply. Real estate investment trusts, REITs, came with a bang about a year or two ago with a lot of exemptions. Regulations were issued, but didn't really take off due to various reasons. So the exemptions given have all been removed. The dividend from a listed REIT has been removed. Gains from realization of units in a listed REIT has been removed. And the realization gain of transferring land or building into a REIT also has been taken out. So the normal provisions in all of these would apply. On property, realization of land, so the exemption of the house that you have, the principal place of residence, is still continuing. But the realization of any other investment property that you may have, companies will now be liable at 30%, and individuals at the lower rate of 10%. Rent income, the withholding tax has now come in at 10% for a resident person and 14% for a non-resident person. And then broadly, this interesting exemption for any government-owned entities, realization of capital assets or liability of an investment asset is exempt, where the gain is made by an entity fully owned by the government, and where the gain is made due to a decision by the government being essential for the economic development of Sri Lanka, and the minister has to approve. So these three conditions will have to be maintained, and gain made on such a sale of a government asset will be exempt from income tax. Then there is this other deferment under section 46(4) for transfer between associates that also has been made more stringent with retrospective effect, where one of the conditions where you transact between associates and both of them have different tax rates, there is a concession. But the worrying part of this is that it has a retrospective effect, and hence transactions that have been taken place from 2018 will have to be looked at carefully to see if undue tax exposure would arise as a result. Personal income taxes, very quickly, again effective from 1st October 2022 as per the bill. So do keep in mind that it's only a bill and there could be changes to this effective rate, especially since it has gone to court as well, on at least the timing, right? So personal relief reduced from 3 million per annum to 1.2 million per annum, so that's 2.5 lakhs a month to 1 lakh per month, and the rates have gone from 80% to 36% max. Expenditure deductions, medical, interest and education of 1.2 million has been removed. However, the 600,000 allowance given for fixing solar panels on a residence will continue. So the PAY scheme is to come back, and that is going to come back. It's called the APIT scheme now. Will come back with effect from the passing of this law, right? So when the law gets passed, only there will be an obligation by an employer to actually withhold, while the rates, higher rates, if passed as it is, will apply from October 1st. So there will be a mismatch there between what is withheld and what your liability is. So that will have to get bridged in the return that individual will file. So this is the comparison. Yeah, so from April 1st, 2021 to September 30th, sorry, yes, the first half will be the old slabs, 1.5 million, because it's half a year, it's prorated, and the new slabs will be 600,000, that's half of 1.2 million, and then 500 slabs you'll take half and apply these rates. So that's how this year 21-22 is likely to look like if this bill is passed. And then after that, from 22-23 onwards, that's from next year onwards, it will be the full slab of 1.2 and then 5 lakhs for each slab at an incremental rate of 6% up to 36%. So this is how it looks as an example. So anyone paying 1 lakh will not pay a tax. 2 lakhs under the existing law, you pay no tax. Under the new law, you come up to a maximum of 18%, paying 10,000 rupees, 10,500. Someone getting 5 lakhs would have paid only 15,000 under the old law, will now pay 106,500, and someone under 5 lakhs will be at the 36 range. Additional tax they will pay is 91,000. Anyone getting $1 million rupees earlier paid only 90,000, now will pay 286,000, almost 3 lakhs, right? At an increment of almost 200,000 in terms of tax. So significant impacts to this mid-range from 3 lakhs to about $1 million. Those who are earning 3 lakhs to about $1 million in per month. So that's all the slides from myself. Happy to take any questions during the panel discussion. Over to you.
Thank you, Sulaiman. Very detailed presentation. When I looked at it, it looks like our disposable income, not only from the company's perspective, but from the individual perspective, is going to go down quite drastically. So I think we may have a significant impact on that in the industry that we are talking about, that is the financial services industry. We have very well experienced representative from that industry in our forum, in our panel. That is Mr. Nandika Buddhipala from Commercial Bank. Nandika, can I ask from you your initial comments on how this act may affect the financial services industry, the banks of Sri Lanka?
Thanks, Aruna. There again, thanks, Sulaiman, as usual, the detailed presentation, always. Yes, now when we look at maybe the banking sector, Aruna, when it comes to economy, whatever the kind of drastic impacts that's going to get reflected in the economy is going to get really very much reflected in the banking sector as well. When we look at the direct impacts coming from the corporate tax running from 24% to 30%, there's a sharp increase of 6% over there. Then the financial VAT from 12 to 15%, quite unfortunate element of the financial VAT as far as the banks are concerned is that it's very difficult for you to pass it on to the customer. Then the important element is going to be the social security levy, which is encompassing certain amount of turnover tax, having very, very cascading effect and having impact the inflation also is going to come back. With all that, as far as the banking sector is concerned, the disposable income of the people, as you correctly observe, Aruna, is going to have some kind of an impact. When that impact is going to be there, now, when we look at the pay, since we have slightly touched on the pay side of it, when you look at the pay side of it, there are certain products which are very popular among maybe younger generation, like leasing, credit cards, maybe personal loans. Different banks have different amount of exposure to these products. Now, they normally what they do, there is a percentage that you allocate where you can pay loan installments through your employer. Employer directly has interaction with this, and they deduct and send it to the bank for banks to recover it. Now, when the significant impact is going to have on these kind of the pay taxes in place, I think there can be certain disturbance to the young professionals who are there to come up with these kind of repayments. Those are the kind of nitty-gritties, but there again, when we look at the issues as far as the increasing the corporate tax, increasing the financial VAT, the corporate tax running from 24 to 36%, then the financial VAT from 12 to 15, another 3%, and top line there again, it's very, very different. The 2.5% as the social security levy, as I can remember, it has been effective. Maybe Sulaiman can correct me if I'm wrong. It's effective from October itself.
October 1st, that's right.
Yeah, so we have already impacted some of these. So all these tantamount to maybe reduction in your profitability. Of course, then the reduction in profitability for a banking sector is a slightly different issue altogether. Then what will happen? What you are going to allocate or increase, keep aside for the capital is going to have impact. So now when we go through this kind of distress time, then the impact which is coming to capital through as a direct result of some of these implementation of taxes is going to have a kind of an impact where maybe our lending capacity can be restricted. Then sometimes we know that we are just confronted with certain maybe restructuring of the ISBs also. With that also, then there is huge amount of absorption of the profitability. Then the impact is negative, quite obviously. Then the issue is we know that we are running into a debt to GDP of maybe about 110 to 120%. We were having it around the 75-80%, quite maybe up until maybe 4 or 5 years ago. Gradually, it has been increased. Now, for us to come up with the sustainable debt trajectory, maybe to bring it down to level of maybe 80% or maybe at least 100% over a longer period of time, then sometimes we might have to look at some of these to maybe the restructure it, as well as maybe increase the tax. Now, tax as a percentage of GDP, we know where it was. Early 90s, it was maybe, as I can remember, about 20% of the GDP. Now, it has come down to 11, 12% when it came to maybe 2012, 2014. But later on, it has gone down to 8%. When the tax revenue is coming down, and quite obviously what will happen with that, debt to GDP is running up. We are in a bit of a debt unsustainability. I think quite interestingly, the late Dr. Saman Kalagama mentioned about it way back in 15, 16. Very, very in detail in one of his maybe introductions to maybe one of the books which he edited. So we have gone through that particular path. So it's a keeping a balance between the financial sector stability, from the other side the debt sustainability. So it's maybe sometimes I can remember maybe the president himself mentioned the fact that he's going through a different maybe very narrow path. So we are going through that narrow path. Quite obviously, we can see as far as the banking sector is concerned, we have certain the issues that are confronted as a direct result from these tax increases. So very briefly, that's what it's Aruna, rather than getting into too much of details.
Thank you very much, Nandika. We'll come back to you with questions later. So a kind reminder to the audience, if you have any questions, please please post in the chat box so that I can raise them with the our panelists as well as the speaker. Moving on to Dilshan. Dilshan, as the chairman of the Colombo Stock Exchange, I think Suleiman also touched on that area a little while ago uh, about various changes in the tax laws or tax concessions that might affect the companies. Not only the companies that are there already listed through higher income tax rates, as well as the companies that want to get listed, that are interested, that are contemplating getting listed, as well as the ones that just got listed. Overall, what do you think? Wow, how you look at this the new bill from a perspective of a listed company or company that is about to be listed?
Yeah, Aruna, thank you. And thank you to First State, the CFA, for having me on this panel. And thank you, Suleiman, for a fairly comprehensive presentation. So I think there are sort of three elements in terms of, I'll try to answer your question. So the impact on listed entities, maybe the impact on newly listed entities, and the impact or potential impact for companies contemplating listing. Overall, I think the tax increase is fairly negative on all of these three sectors, because obviously higher taxes would impact your profitability. And that in turn would reduce investor interest. That in turn would probably reduce liquidity trading velocity. That would affect the Colombo Stock Exchange. So I think it's fairly negative. I need to say that first. But I'll take the second part of it to answer. I think there were concessions offered in 2021 encouraging companies to list, whereby those companies had for the first year, I think, a 14% tax, and thereafter 50% reduction for the next 3 years. Now, 2021 was a record year for the Colombo Stock Exchange because we had something like 15 listings that took place. Some of these were even SME board companies, so fairly small entities that chose to list, as well as the main board companies that listed, primarily looking at this tax advantage as an incentive for this listing. We know that listing on whatever board has certain listing rules, and it's quite onerous on companies in terms of the governance criteria. So if you really go to some other private entities, and we do that from the Colombo Stock Exchange, try and encourage these entities to list, because we want to sort of grow the issuer base. We want to see the Colombo Stock Exchange reflect broadly the economy as a whole, as opposed to what it is now, which is about probably anywhere between 12 and 15% market cap to GDP sort of ratio. We've gone to a high of 30% in the best of times. I think it's fairly very unfair that you sort of set certain rules for these companies, got them to list, go through this fairly onerous process of listing, and thereafter sort of pull the rug under their feet, so to say, and take away those incentives. And that sadly has been a feature of our tax legislation for a long time. It's not new. We've seen it happen in the past, but I think that level of having policy inconsistency really negatively impacts not just from a Colombo Stock Exchange perspective and the companies listed, but even for the broader economy, because that sends out a signal to investors that, we won't be consistent. And if you look at how we've done these changes in the past, we've had policy changes, tax changes, reversals of, making a U-turn, so to speak, probably every 2-3 years, Aruna, right? So this inconsistency doesn't even run the course of administration, right? And the good example is even in 2019, we brought sort of several tax cuts. Now in 2022, we are sort of reversing most of them. So it even shows you that within a period of administration, that you're going to sort of, reverse certain, decisions. And that makes it very difficult from a company perspective and even from an investor perspective to plan, right? Because you never know what's going to happen. And that is not good for the country. Now, I do concede that the current situation we are faced with is an extraordinary situation and probably warrants this action. So I am not in any way saying we had another choice in the matter, right? I think we were pushed to the wall, so we definitely didn't have too many options. But it will kill confidence. And the worrying factor for me really is not the hike in taxes, but the fact that we may make changes on a sort of ongoing basis. And because of that, companies and investors will not be able to plan, right? And that will impact, obviously, even potentially FDI flows. Even if you look at our doing business ranking, these frequent policy changes are going to drag us back a couple of places. And that is not going to then hold in good stead for Sri Lanka, that very desperately needs foreign investment. So on the listed entities, our view is that it's unfair because you brought them in saying you're going to have a 3-year benefit. We have had 50 odd companies go through that process and list, and now find that they are no longer going to get that incentive. Don't forget that the companies also would have spent a lot of money to list. The listing is not a cheap process. Also, the companies have parted with minority stakes that maybe were given at very, very fair valuations that maybe today, if they held on, could have been sort of worth more. We know a couple of companies that have listed part of the, I think, 8 or 9 cases that have been filed in the Supreme Court. So I think some of those companies are taking legal action. I don't know what that outcome would be. But the view of the Colombo Stock Exchange is that it's unfair to do that. And we will also, as an organization, look at lobbying to try and at least for these companies that listed to have that waiver in place for, because it's a short period of time, sort of 3 years. In terms of the first part of it, the other listed companies, maybe who are already listed, I think the impact we've seen is right across the board. So you had all these sectors, except for, I think, as Sulaiman mentioned, probably the agricultural, the growing sort of sector that have been the only one of the few that have not had increasing tax rates. But all others are obviously going to be paying a much sort of higher rate, at a minimum 24 going to 30. And that's going to impact earnings. In turn, when earnings are impacted, we know investor sentiment also is going to sort of wane down and be sort of less because the valuations of these counters are not going to be as attractive as they were in the past. So that is on the existing listed entities. Then thirdly, I think you have the payee tax implications on individuals, which would also mean that disposable income in the hands of investors are going to come down. And therefore, then you're probably going to prioritize your expenses in an order where maybe your investment excesses will not be there anymore. So again, retail activity is going to get impacted in terms of people having, disposable income to invest. So I think on all 3 fronts, it's going to be very challenging for listed companies, for the newly listed companies, for the investors, and obviously then for the Colombo Stock Exchange. But we hope that still with the relatively cheap valuations that the market currently has, that investors would still probably see long-term value, maybe not in the short term. And we hope that even the foreign interest, which we've seen, because after 4 years, we managed to have a net foreign inflow into the country after 2017. And that continues even to date. We've seen that continue irrespective of these tax increases. So we are hopeful that that will sort of offset some of the negatives. And on a long-term valuations, the market still would do well. Yeah, I hope I answered your question.
think it was a very, very detailed answer, Dilshan, and you touched all the points. Especially, I fully agree with you, and all the panelists and audience will also agree with us. Especially for the people who trusted and came to the market, the subsequent reversal would have had a devastating impact. Ravi, moving on to you. From a more investor perspective, we talked about policy uncertainty. We talked about reversal of certain decisions. We talked about the withholding taxes not becoming final taxes anymore when it comes to certain streams of interest and dividends. From an investor's perspective, what do you feel? What will the investor? How should the investor protect their interest in an environment like this? What are your views?
Thank you, Aruna. I think it is like playing football with a moving goalpost. So when the goalpost is changed, it's very hard to hit a goal, or even with blindfold. So that is the situation as far as investors are concerned. Not only that, all of us know that there is a triple impact on disposable incomes of investors. The official headline inflation touched 70%, and now in October it is around 66%, and food inflation is still about 85%. So that's one impact. Then we have the rupee depreciation, which year on year we have had about 80% rupee depreciation. And on top of that, now we are talking of investors being hit by massive tax increases, which Mr. explained. So it is really, really hard for investors to have anything left over to invest. If you take an average investor's perspective, they are facing quite a big challenge with this increase of incomes from, say, maximum tax rate, which was 18% to 36%. Basically, on the very people who pay taxes, it is. I don't see any effort being put in to capture the wider number of taxpayers to the tax net. And what seems to be happening is about 50% increase. So now, if you look at what should be the investment strategy of an investor, is that still they have to go by principles like having a diversified portfolio of assets and make the best possible returns with the risk they are willing to bear. So that is the risk you can bear. So I would go for a strategy. In my case, I would recommend the only good side of this crisis is high interest rates. So you can lock up to get the high interest rates, because we have to accept the fact that in any crisis, interest rates peak, and that is clearly shown in all the countries that went through this kind of crisis where interest rates went up and subsequently came down. But that means all investors will have to take some risk if they are to really benefit in the long run. One option is for a risk taker would be to lock up on the over 30% returns that are given on 3 to 6 year treasury bonds. And with understanding clearly there could be an NPV haircut that would come if the government treasury bonds are restructured, which means a domestic debt restructuring that is being widely talked about, in addition to the sovereign bonds or international sovereign bonds, ISBs, and the development bonds, Sri Lanka development bonds. So if there is the domestic debt restructuring, there could be a hit. But still, even after, say, if you take a 20% NPV haircut, you will get a decent return of 20% for a very long time. So that is something I would tell investors to look at if they are able to take that risk, that it is for the risk taker. So, in a crisis, you always have to look at where you can do better. You can't look up and wait. So this is one alternative. But if you are still quite risk averse, there is the benefit of 3 months treasury bills, which is also paying 32 or around 33%. So you can benefit from that for a short term until the inflation declines and make some return. Maybe say if 3 months you get about 8%. So that's one. And also we will see very soon some debentures coming in from the banks. Of course, these are tier 2 capital, which is basically there is a possibility of central bank calling or asking the banks to convert these to equity. So that risk is still there. If there is, or actually that risk has been always there, but now it's much higher because of the domestic debt restructuring possibility where banks will have to be capitalized. So those are on the fixed income space. On the equity side, as Dilshan very clearly mentioned, there is opportunities. We are going through well, Sri Lanka is predicted to have about negative 8.7% growth. That is, and also not only this year, but next year as well, about another negative 3% in 2023. So under these circumstances, we will see opportunities coming up in the stock market where share prices will come down, and if somebody is astute and a long-term investor, they could pick up these stocks. Just like during the height of the war, people bought into some good stocks and made very good returns. So if you are a long-term investor, I would strongly advise to pick some good stocks as the fundamentally strong counters come down. Obviously the banks will get hit even more if there is a domestic restructuring, and then thereafter it will be only one side going up. So as Dilshan said, we have seen already some net foreign inflow into CSC. That is what the foreign investors do. They are smart. They know exactly what happens. Things come down and then go up. So, yep. Hope, as Nisa mentioned, that we will not see a capital gains tax brought in to the stock market in the budget because there is this 0.3% share transaction levy already on the stock market. So we don't want to see any more damage like policy inconsistency that you very clearly highlighted and also mentioned. More damage to the investors because already the damage is done. Thank you. Aruna, you are muted.
Sorry. A very detailed response, Ravi. I think hope that investors have the resilience and adaptability to withstand the storm and then earn profit. Some people say the crisis and the chaos is the best time to earn the best profit in the world. Let's hope that it will happen for it will happen to us as well. So moving on from the audience, I've got one question. Rule has been taken out or post or not? That's one of the questions that I've got in the Q&A session. Can you hear me? Hello?
We can hear you.
Yes, Aruna, we can hear you. I couldn't hear the question. And who are you directing the question to?
Sulaiman.
Okay.
I wanted to check with Sulaiman.
Yes, no, sorry. What was the question?
Question was, Sulaiman, one person wants to know whether the thin capitalization rule has been introduced in the new bill.
No, it has always been there. It was not made applicable for 1 year due to COVID. It is the last year it won't be applied, but it will continue from this year onwards. The capitalization rule where a company has to be adequately capitalized in order to deduct the full interest expense.
Thank you. Thank you, Suleiman, for that clarification. So till I get some more questions from the audience, Nandika, I have a couple of questions, very interesting, the comments that you made regarding the prospects of the banking and financial services industry. With the increase in what you call all the interests, and probably with the interest rate increase, if you have given the variable rate loans, the loan installments might also go up. Banks might come down. So in that type of a scenario, near future, how do you plan to manage, Nandika, that area?
Sorry, Arun, I think time to time there were a number of disturbances where I couldn't hear you properly. I think what you want to ask is with this kind of volatile interest rates prevailing the marketplace, how the banking sector is going to manage.
Let me add a little bit. Volatile interest rate and the increase in interest rate might increase your loan installments. But at the same time, the higher taxes might result in the disposable income of individuals and the companies to go down, which might, as you correctly said, it's a mismatch. And do you think NPLs are going to go up? And is there a strategy that the banking sector adopting in that area to address it? What are your views on that?
Yeah. Thanks. It's very pertinent, very good question. People speculate so many things, in maybe going into so many extremes as well. Since that those kind of speculations are in the marketplace, then on the top of it, as I think Dilshan very correctly mentioned, now the market cap as a percentage of GDP would have gone down to maybe 16-17%. Maybe it was later on, maybe 5 years back, maybe 20%. Whereas maybe the debt, as far as the lending of the banking sector as a percentage of GDP would have maybe gone ahead, maybe about more than 50%, I suppose. So the impact that financial intermediation, which is going to get created, maybe for a shorter or medium period until the stock market is going to come back and revive and thrive, is going to be very significant. So then when it is like that, then the stability of the financial sector, banking sector, as we speak, is going to be much more important than which it would be under normal circumstances as well. So you need to push it through. We need to get out of existing issues. Maybe in the short run, with the support of financial intermediation and banking sector itself, until we get into other means of the capital markets. Now, when you look at the current situation, when we have this kind of the high, very high interest rates, there again, which is coming from maybe the bond issuance as well, where we are not resorted to printing money again, because that will have a huge impact on the debt sustainability. We are adding into that. Then what will happen as we speak? What's happened? Then there's huge amount of scarcity in the liquidity in the overnight markets. Then the issue is the absorption of maybe the funds from the market. Unfortunately, the bond the rates have gone and hit the ceiling. Now the issue is how we are going to manage it. There again, the issue is when it comes to the lending demand at the moment, we can't see a kind of huge demand. There again, when you look at the net situation, you can't see it very clearly, because there are repayments as well. Even as we speak, there are repayments which are coming through. The net increase in lending always reflects over and above the repayment what you lend. So then this disparity is not very clear in the sometimes marketplace. They really think that there is no growth, or when it comes to maybe slowdown. Now, how we manage this volatile situation, specifically when the disposable income is going to get affected. And there again, the pertinent issue is NPA. Maybe to look at very critically, I'm not going to say the accounting standards help us or whatever as a chartered accountant like the Suleiman and myself. I'm not going to say that that is the case, but expected credit loss and specifically even the central bank moving away from the NPA, but they are again resorted to the stage 1, 2, 3. Stage 3, what we call as impaired loans, has so many other connotations than the time-bound 3 months or 3 installments. That is, if you really restructure twice some of these the facilities, then you need to push it to stage 3, and we have to call it impaired. Then on the top of it, if you feel that maybe one particular the organization is running into certain difficulties due to significant increase in credit risk, irrespective of the fact, even though the maybe installments are coming through, still you need to push it to the stage 3. So a number of things has been taken place, and there again, when we look at the old classification of NPA, 3 installments and stage 3 loans. Stage 3 loans are much bigger than the NPA. I'm talking about the banking sector, entire banking sector, not only for the commercial bank, because we need to have that particular interest of looking at the entire industry rather than only yourself, because we are so interdependent each other. We need to look at in a very sustainable manner. Then the other issue is going to be when you look at the stage 3, when you look at maybe current parameters, then you need to make certain provisions. When you look at it, what happens? We came up with not only us, I think specifically we gather this experience from the European market, where they have gone through huge issues as far as the COVID-19 is concerned. So what they have done, they dependent on what we call as huge amount of management overlays, meaning your statistics doesn't give you that you need to impair or need to make provisions, but you need to make huge amount of provisions by stressing the situation, putting the worst case scenario into practice. Say, for example, we look at what we call as economic the factor adjustment, where when it comes to collective impairment, you multiply it by that particular factor. That particular factor, normally you have worst case, best case, and the best case. You give a weightage maybe about 40% to or 60% to the base case. Now, what happened? 80% the weightage was given to the worst case. Then when you look at stage 3, the entire banking system, the most of the time we have 40-45% kind of impairment provision, which is already there. Then when we look at the moratoria, one after another, we went through from 2019 onwards. There is a very much drag-on effect as far as the tourism industry is concerned. Then what happens each and every moratoria, the first moratoria, a huge amount of loans went under moratorium. But there again, slowly when it went to second and third wave, we have seen less amount of the facilities or the value as a percentage of total the lending book has gone into it. Slowly it is resolved. But maybe the last one, I don't have the statistics in the banking sector, but I think last moratoria would have gone into a bit higher situation, not purely because of the COVID or other issues, but as very well articulated, as the Ravi articulated, we have gone into a different tandem there. There can be certain increase. Now, that is also going to be very fine looking kind of phenomena. We need to see whether these management overlays are going to support for us to go through this. Sometimes, maybe not. If it is not, then there again, it is not suddenly you hit with something. And suddenly you have to make a provision of 50%. We have already made provisions running into nearly 50% as we speak now. Sometimes some of the banks, when you look at stage 2, normally the loans are much higher than the stage 3. As I can remember, even the stage 2, as far as commercial bank is concerned, we have more than 10% provision over there as well. Now, then maybe the situation may not be that bad as such, we should look at how the things are going to get evolved in. And then there again, the interest rates, the Aruna, they need to be very, very careful when the rates are running into maybe 30% plus. Then who's going to survive with that is one of the other issues. Of course, yes, you can lend and then thereafter get a huge amount of interest margin. But where again, what will happen? Eventually, it will go to NPA, and then thereafter that issue is going to be a serious issue for the banking sector. So the sector is very, very carefully evaluating the situation, and maybe moving forward with the inflation slowly maybe coming down, maybe month on month, maybe gradually towards the middle of the next year. Then whether the interest rates will have some amount of resilience, then how we can manage it is a fine question that we need to see how the things are going to get emerge. But what I'm trying to say here is when we look at forward-looking, the provisions that the sector has been providing will give some kind of a support to weather through the worst circumstances which are going to get hit. So it's something that we have not completely prepared for. It is not that 100% prepared for as well. So we are somewhere in between. Then we should not allow, without looking at those factors, to speculation to give the 100% correctness. So need to make a justice to that. So then it should be a calculated kind of decision, calculated kind of reading of the market.
Thank you, Nandika. Very detailed answer. You went into even looking at classifying the loans and basically how you look at it. It's very interesting. I'm sorry, I have to ask another question from you because one of the members in the audience wants to get your views as to, it's a tough question. I have to admit that before asking, whether you expect a haircut on the treasury bills and bonds the banking sector holds.
That's another very, very interesting question, Aruna. There again, we need to be fair and transparent, and rather than there again giving room for speculation also is going to be a problem, because there is one the renowned economist came up in the recent past where he said that he expect the haircut. Then there again, as far as LKR is concerned, then another report came from one of the foreign banks. They are again a huge amount of research that they normally used to do somewhere in June. They also talk about some coupon cut. Now we need to look at how we are going to get away from the debt sustainability issue. One pertinent thing is that it looks like to me that we are very committed to make primary deficit or maybe government expenditure compared to government income. We are trying to match those two because we have given a target for us to be in the positive side by 2025, 2.3%. I think the authorities are kind of looking at it very, very seriously. Then the other important element is going to be how we are going to be sustainable as far as the debt servicing as well as interest payments and others are concerned. I believe irrespective of all the other issues, gradually we need to get into a reasonable the interest rate level regime. How we are going to get into that, I'm not very sure. But the one very important element is what we call as medium term, long term, and the short term. Now, when we look at the bond perspectives, we normally used to have our interactions with certain financial advisors and the legal advisors who used to support the other bondholders in the world. Now, we realize the fact that when it comes to 10, 15 years, it is the short run for them. But for us, I think Ravi will understand, maybe elaborate. Our unfortunate thing is when you look at our situations, 10, 15 years, it's a very long run for us. So maybe when it comes to the restructuring, they are willing to look at a maybe instrument or reissuing of ISBs running into maybe 10 years horizon, over and above the maturity, the current maturity levels. If we have that particular acceptance in the bondholders marketplace, now what we need to look at is the emerging situation and the how we are going to come over the debt sustainability issue without touching the local the instruments. Maybe one classical example in the recent past has been the Zambia. Of course, yes, we are not very sure how they will go through it, where they have not really touched the local instruments, what we call as DDR, domestic debt restructuring. Then there again, maybe a lot of discussion which went through in the recent past as far as the common law countries are concerned, where they have a huge amount of interest not to disturb the finance sector in the world when they come to maybe debt restructuring and the issues that similar to what we are facing at the moment. So as far as ours is concerned, the central bank continuously given the assurance that the local instruments are not going to get touched. Then we are also going on the same proposition because it will have severe impact not only to the banking sector but even certain other longer term the institutions like PPF, ETF, and others also, other pension funds as well. So as we speak, we are not in that particular speculation as to the local instruments will get a haircut. There again, we feel the debt restructuring can get into medium-term instrument, the issuance of the certain other instruments, where we might be able to get over it. Then where they are again debt ballooning or adding into the debt further by having a different the fiscal issues, maybe managing the expenditure side much more than what we should be doing. Of course, yes, maybe as far as the government expenditure is concerned, maybe it is going to be a bit difficult immediately to arrest situation, because significant part of expenditure is there as recurrent as well as the salaries and wages of the government servants. Then the discretionary other expenses, specifically rather than us running into non-tradable sector, maybe the construction and others, I think that definitely is going to get disturbed. And as far as non-tradable, definitely the government will look at, if at all, maybe projects or repurposing of the certain projects which came through from maybe the IMF or the World Bank or ADB, where putting it to certain projects where they can earn foreign currency. So that particular commitment is there. As far as the SOEs are concerned, we know petroleum price has increased, then the losses have been minimized. Then hopefully not only the Sri Lanka Electricity Board, but even the Petroleum Corporation eventually will have some amount of not eating into the government budget. Let's hope for the best. I think I have given a reasonable answer, not trying to kind of give, even though it has been projected by so many different people, rather than giving hands to that speculation. What I'm trying to say here is the finance sector stability is part of debt sustainability as well. You cannot really detach it. You just put it to maybe the financial sector destabilization, and if you expect with that the debt sustainability is going to be achieved, no, it's really you are committing suicide by doing so. So then not only, I mean, since we are working for banks and we have interest in banks, not purely because of that, when we look at maybe financial intermediation and banking as a percent of GDP now would have gone up to more than 50%. So it has a huge amount of role to play. And the people, if they lose their confidence in the banking sector, that's going to be a serious issue. So after looking at all that, I think the touching local instruments is going to have an impact on the banking sector. That is one of the primary reasons why even the central bank has never speculated on that. Let's hope for the best and feel that it's not going to get disturbed. So that's what the understanding what I have at the moment.
Thanks for that explanation. I think a lot of speculations are killing the sentiment, and I think it's a very fair answer. Ravi, over to you. There's a question from the audience, whether they should be expecting more taxes from the 2023 budget, I think, which is to be tabled or which is to be presented to the parliament on 14th of November, I believe. The member of the audience have specified whether you think things like wealth taxes are going to come in. What are your views, Ravi?
There is some speculation that there will be a kind of a capital gains tax, which is already there, but there is in Sri Lanka, we don't have wealth tax as well as estate duty kind of, when you passed on your inheritance, there is no taxes in Sri Lanka at the moment, but just speculation. I do not envisage further burden on the people because already a lot of burden has been brought in, and additional taxes will just kill. Now already I think the middle class is compressed. In fact, the point that didn't come out is that people who basically get a fixed income, say a salary, and suddenly these taxes have been brought in, which is basically additional 50% of their income, additional 50% of taxes. So it is overbearing because they would have planned to pay a certain, say, housing loan to a bank. They would have planned to send somebody abroad, like a child, for further education. And rupee depreciation had hit them by 80% already. On top of that, you bring in this kind of taxes. How do they manage? I think that's something which the people who have put these taxes don't understand. I believe they have to be, thinking all these aspects, doing research and seeing the impact to fixed salaried people on how they are going to manage their life, not like putting taxes to other organizations, but individuals pay taxes, and the impact to them is massive. So on top of that, putting other taxes is out of the question in my view. Of course, governments doesn't have that fairness or thinking in that terms. They may just think, okay, we have to increase our revenue to as a percentage of GDP, and that's all. But there are thousands of ways of doing and achieving our target without burdening the few people who pay taxes. And 250,000 files, it's not what should be done. And just to touch on domestic debt restructuring, I totally agree with Nandika. The costs far outweigh any benefit of doing it. But the theory or the thinking, again, just like the taxes being imposed, is that, we can reduce our debt burden. Basically, I think we can bring it to about 100% if we go for some kind of repayment, delayed payment for domestic debt. So there are thoughts like that, but I have looked at the impact. The impact is massive, including to central bank itself. So if anybody comes up with these ideas, they should see what is the impact, like Nandika explained. It's huge impact to all the banks, the EPF and central bank itself. So it may have happened in other countries for other reasons, like in Greece or wherever, because it's euro, so the currency is euro. But that doesn't mean we have to do the same at a huge cost.
Thanks, Ravi. Since we have overshot the time by now 7 minutes, I'll ask one final question from Dilshan before we conclude the session for the day. Dilshan, we know that a lot of people, it may be fair, it may not be fair, depends on tax concessions to get incentivized. And that is one of the complaints I've heard from people also. So as the Colombo Stock Exchange, in an environment where tax concessions may not be that much prevalent in the near future, what are your plans to encourage new investors or new companies to list in the Colombo Stock Exchange, which are not tax-based?
Sure. So I think obviously we want to broad base the issuer base, widen the base so that it reflects the greater economy. And that's something that if we don't do, will hinder the foreign flows as well into the country. So the stock exchange was never lobbying for a preferential tax treatment for listed companies. I think that was done by most of the issuers who wanted to list, who got that one-off, and which we very well understood was a period for 1 year. So it was not something that people were asking for continuity on. It was a one-off to encourage listings. And then thereafter, after 3 years of that incentive or that preferential tax treatment, those companies would have reverted to sort of normal tax base. So just sort of laying that upfront that was not really something that we are pushing for. But what we would like to see is sort of consistency in the tax policy, and the tax policy to remain unchanged for a medium to a long term. And if I need to put in that in context, I would say at least for 5 to 10 years at a minimum, maybe more, that you have consistent tax policies that can then attract. But in terms of the exchange, what we are trying to do is, I mean, the Colombo Stock Exchange, the whole purpose is to channel capital, is to raise capital for these companies. So we still believe that the market is one of the only places that issuers can access investors at a reasonable cost to access capital. And in that sense, what we are doing is, apart from the various sort of educational activity, promotional activity, going to sort of family businesses and showing the benefits of listing, which are on many fronts. For example, the governance the governance requirements that come about for a listed company would elevate that company's status and act as a sort of credible enabler to attract capital. So that's essentially what we will go and sell to unlisted companies, asking them to list, saying, look, if you list, then you're going to sort of conform to listing rules. You will have to conform to corporate governance principles. That would elevate the status of that company and thereby enable that company to access capital markets in a cheap and efficient way for their business development purposes, whether it's expansion, working capital, whatever those means are. So what we are trying to do is that from an issuer perspective. From an investor perspective, I think the numbers that we have on the investor base are quite low, Aruna. Even though we've had encouraging signs over the last 2 to 3 years, we only have about 800,000 accounts or CDS accounts that are there, that have been opened. Now we are a population of 22 million. I would think a bankable population of 15. If you just take people who have sort of, over 18 who have a bank account. And of that, we only have, of those 800,000 accounts, only 250,000 accounts that actually have shares in them, right? Have a portfolio in them. And if you look at investors who actively trade, that number is even lower. It's at about 50 to 60,000 of active investors. Active investors are defined by at least one trade a quarter. So someone who does sort of, 4 trades over a year. That's a very, very small number, right? So what we are trying to do is broad base that, and there are many things that we are doing to broad base that. We are introducing new products. We are introducing a CCP and improving infrastructure. We are doing investor education. For the first time, we've been successful along with the regulator, the SEC, to include capital markets in the school curriculum. So we are hopeful that in 2023, you will actually have a capital markets curriculum that will be taught in our national schools. So really, we are trying to do all of these things, the infrastructure, the investor base, all of that would then make companies having a wide access to that investor base. And thereby, that's the reason why then they would essentially want to list to access that capital with the higher governance standards and so on. So that's really what we will focus on over the next couple of years.
Thank you, Dilshan. Thank you for that detailed answer. Again, I would like to thank Sulaiman, Nandika, Dilshan, Ravi, all of you for participating in today's discussion and webinar, so that I hope we have shared some views and we have clarified some of the doubts people had. And thank you very much again. And thanks all the audience for staying with us for even more than now 1.5 hours. Thank you very much.
Thank you all.
Thank you.
Thank you.